Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Luke Youngblood, founder of Moonwell, as well as Erbil Karaman, co-founder of Huma Finance, and Adam Simmons, Chief Strategy Officer of Radix. We're here to discuss how global competition is fostering innovation in the digital asset space. It is great to have the three of you with us. Welcome to Trade Talks. Luke, just for some background, I want to kick it off with you. Give us an idea of where you sit within the digital asset ecosystem.
Hi, Jill. Thanks for having me. So my name is Luke Youngblood. I'm the founder of Moonwell. Moonwell is an open lending and borrowing application on the Base network, which is Coinbase's layer 2. To give a quick intro to what we do, we provide the borrowable USD coin liquidity for the Bitcoin borrowers on Coinbase. Your listeners might have heard about the Bitcoin Borrow product that Coinbase recently launched in January, where this allows Bitcoin holders on Coinbase to borrow digital assets, to borrow stablecoins against those. We provide that borrowable liquidity, and we also provide a money markets protocol on the Base network. So really excited to be here and can't wait to jump into the conversation.
Yeah, it's going to be a good one. Erbil, tell us about the work that you're doing.
Thank you, Jill. I'm Erbil, co-founder of Huma Finance. We are the first PayFi network. PayFi is payment and financing. We help large financial institutions and payment institutions with cross-border payments, card settlements, stable card-backed cards. We work with various different geographies around the world, and we just crossed $6 billion in transactions, growing more than 50% month over month. Excited to be here.
All right, you got in Adam Radix.
Yeah, thank you for having us on. So I'm Adam Simmons, the Chief Strategy Officer at Radix. We've been around now since 2013. It's a layer 1 network, really solving the problems around scalability, DevX, and UX in the DeFi space. So Radix is a full stack L1 network, really looking to serve for global finance at both an institutional, retail, and all the levels that we haven't even thought of yet.
Yeah, and it's interesting, Adam, because we're starting to hear more of the conversation around UX and integration, and it's no longer an us versus them sort of conversation. You could tell that the space is really matured and what's young relative to other asset classes. Do you think DeFi and TradFi, are they ready for each other yet? Or is there more work to do when you think about scalability and integration?
There's definitely more work to do, and they're kind of digging a tunnel towards each other. So in the UK, there's a lot of push around open banking and things like that, of being able to connect multiple bank accounts into your same mobile app or something. On the same side, on the crypto side of things and DeFi, we're already doing a lot of those things without the nice customer service, without necessarily the nice UX that people would expect. And those two things are kind of channeling into what the future is probably going to hold for the entire financial market. Ultimately, people need to feel confident in how they're using any kind of assets, be that cryptocurrencies, digital assets, or traditional financial services. And I think they'll start to blur the line of what people are using, as you're seeing things like Revolut do in terms of their crypto offering.
Yeah. And Erbil, certainly the fact that the Genius Act is having a moment, we're starting to get regulatory clarity here within the US is helping to move from speculation to understanding how the infrastructure works and what it's capable of, besides just, trading, hedging, speculation, and so forth. And that this is actually, the next step for the iteration of global capital markets.
It is indeed. So I was at the White House for the signing ceremony because it's a big moment for us. We've been building enterprise solutions for institutions for the past 3 years, and we've been able to get this to be adopted across the world, except the US. Everybody in the US knew that this is so important to be able to utilize stable coins and to unlock the payment rails, because Swift, as we know it, doesn't necessarily work in the modern day. People need 24/7 services, and only blockchain and stablecoin based services can provide those. And with the Genius Act, we're seeing a large amount of demand just basically being realized on the institutional side in the US. And now, the US can actually become the driver of these innovations finally, instead of the rest of the world doing that for us.
Yeah. And look, it's interesting. I mean, stablecoins is really it's going to change the way that Americans think about DeFi and mitigating that de-dollarization story.
Yeah, absolutely. I think, for example, the passage of the Genius Act has basically made it so that the dollar, which is very desirable outside of the US and Europe, where we already have good banking services, the dollar tends to be better than most local currencies if you live in Latin America, parts of Africa, and Asia. And I think that those of us that live in the US or Europe and have access to good banking services forget that most people would like to transact in dollars globally. And the passage of the Genius Act actually makes that more certain because, now it's legal for US banks to custody it on their balance sheet. And the Bank of America and Chase CEOs have both expressed interest in either launching their own stablecoin or maybe adopting Circle's stablecoin. We're not sure which yet. And so I do agree that there's more infrastructure to be built over the next few years. There will be all this banking infrastructure built that will kind of bring the DeFi and TradFi worlds together. And it's pretty exciting for us, those of us that have been building in the stablecoin infrastructure space for many years now, because it's a very attractive value proposition for a large bank like a Chase. For example, you can give Chase $1 and they give you a digital dollar. Maybe it's a Chase coin. The benefit they get is they can buy a T-bill that earns 3 to 4% and hold it on their balance sheet. You just get a digital dollar that gives you the ability to have instant cross-border settlement. And now you have all these benefits of a digital dollar, and the banks are going to make a lot of money off of the treasury yield. So it's quite an interesting scenario where you have a win-win for both the banks and for the DeFi and for the consumer.
Yeah, I appreciate you bringing that up, Luke, because we do tend to think very US and Western centric, where we take it for granted that there's legacy banking institutions and accessibility, where the fact of the matter is a couple billion people have leapfrogged over that and are growing local microeconomies through cross-border payments and alternative forms of capital formation. And I think that's important for us to recognize and educate ourselves so we understand what the use cases are. Adam, do you think we'll start to see consolidation among chains like you would in, traditional sectors, if you will?
100%. So chains are ultimately like a platform business at the end of the day. And usually you see an innovator come into the space, in this case, things like Bitcoin or Ethereum, then proliferation, where you get many competitors with kind of marginal improvements come through. A few then start really standing out, generally kind of like the third, fourth generation ones, solving many of the problems, consolidating, getting the network effects needed. In this case, speaking of stablecoins, like more stablecoins issued on them, more usage, more users, more capital, more financial products being launched. And then people gravitate towards those. I mean, most people use 1, 2, maybe 3 social networks at most, not 10, 20, 30. It's not practical. The other piece, just a kind of challenger piece, Luke mentioned around the banks being able to make a lot of money from stable coins. I think one of the really interesting things we're going to see is consolidation of stablecoin usage as well. There's going to be proliferation, which is happening off the back of this, that there's going to be many new issuers. But ultimately, it's going to become a competitive market, because if you're making 3% off issuing a Chase dollar, for example, and you are HSBC and you maybe offer 2.5% is your margin, and 0.5% of that goes to the holders of your coin in some way, shape, or form. And that's really what you see on things like index linked funds and things like that, that it really is a low cost economy at the end, and money and capital consolidate within those.
Yeah, which is interesting, because Erbil, the flip side of that is global competition is helping to foster that innovation as well.
That's right. So I also spent some time in Korea, and I'm going back to Japan in a few weeks, because Japan was one of the first countries to adopt the US-based stable coins. One of our partners there is SBI Holdings. They were the leading, party in terms of getting the US stablecoin. But also Japan is right now pushing the yen stablecoin legislation. Korea is pushing, their Korea won stablecoin legislation at the same time. And we're seeing also, Hong Kong taking an active lead on the yuan side. And everybody is trying to figure out what is their strategy to plug into this competitive landscape, because nobody wants to lose to the dollar's dominance on the global marketplace. And because stable coins are by nature global, people want to create regional strategies and to protect their national regional interests. So we're very actively involved to actually help legislators in those different jurisdictions to figure out their position in a complementary way to the US dollar stable coins, and mainly to activate their trading arms that are more global. So for Japan, that would be the manufacturing arms of the cars and electronics companies. And for Hong Kong, it's going to be, helping the China-based manufacturers to plug in better to the trade routes and supply chain routes. So we're helping actively to figure out, how they can really plug in a way that doesn't become a competition across the board, but it becomes a complementary set of services and a complementary set of, currencies working together on chain.
It goes back to what Adam's point was, Erbil, and I want to discuss that for a moment. It's almost when you think about streaming services, or as Adam had mentioned, social media platforms, there are so many of them, and it gets to a point where you have to make those critical decisions in terms of it's just too much, right? So
That's right.
The point you're trying to make is they need to be complementary of each other, because if you're just creating them for the sake of creating them and not solving a problem or making them useful, it comes back to user experience at the end of the day. If it's not useful, it's not going to grow at scale.
That's 100% true. So we anticipate only a handful of stablecoins will be in major circulation, but there can be complementary because stablecoins can be programmatic unless the fiat. And you can say, I want to send US dollars from my entity, but for the merchants in Asia, I want this to show up in, in the currency that they want to use in fiat. And you can actually set up these structures, and you can make more of these, solutions complementary of each other, because some of them are better for the local demand and local use. Some of them are better for global trade.
Yeah. Luke, you'd made a point before that this could strengthen the US dollar's hold on international economies abroad. I think, from the US perspective as well, being able to access our treasury market, our, equity and bond markets through the use of stablecoins, tokenization, and how this continues to get more digitized for the American economy, that could be a benefit as well. And I think that's perhaps why regulators and policymakers are starting to come on board as they understand these use cases, because a lot of, you have a massive addressable market that never had access to the US in our asset classes.
Absolutely. And I think you're raising a really good point, Jill, and that is that, not only is there global demand for the US dollar because it has better purchasing power, it holds its purchasing power better, but there's also a demand within the government and, the administration to actually increase the issuance of treasury bills. We've lost a lot of countries that used to buy treasuries are no longer buying them, like China, for example. And so that means there's a natural sort of replacement theory where you could kind of replace all of the China demand for US treasuries with stablecoin issuers. And I wanted to address something Adam said earlier about, the banks maybe competing against each other for who can offer the best rates. There's one challenge with that, is that the Genius Act makes yield-bearing stablecoins illegal. And so unless that is changed, maybe through lobbying efforts to Congress, banks won't be able to pay yield on stablecoins. And that means that there will be this healthy competition between them. And it's probably going to take some of them years to figure out. I agree with Erbil that we're going to see some really interesting services in the fintech space that will kind of meet these needs. For example, we partner with a company called Bridge that's part of Stripe. And Bridge is a stablecoin company that basically offers you the ability to say, I want to send Circle's USD coin in, and I want to receive Tether on Tron out, because Tether on Tron is one of the most useful local currencies in Nigeria. Most of the merchants accept it, and so you can have these like sort of neobank fintechs. This is why Stripe is building it, because they want to basically accept e-commerce payments in 140 countries globally. And just to give you a real world use case, SpaceX was able to sell satellite, their Starlink internet service, in over 100 countries overnight, and they're using Bridge. And the way they do this is they are able to accept payments in the local currency, so there's no real forex. It's converted into stable coins and then off-ramped back to their US financial institution. And so I think more and more we're going to see multinational conglomerates, companies that want to sell goods and services in hundreds of countries or 100 plus countries globally, use stablecoin infrastructure and rails as a means of getting all those dollars back to the US. And it's going to really, I think it's going to really make global commerce explode over the coming years. And then, just to give you some numbers behind that, there are 2.8 million e-commerce websites that use Stripe today to sell goods and services, most of them direct to consumer. There's over 8 million software engineers that build e-commerce websites. And all of those engineers and those e-commerce websites now have access to a global marketplace where they can receive dollars in their bank account within minutes or hours or days potentially. So that's pretty compelling, I think, for a lot of businesses. Yeah,
I would agree with you. And Adam, now that we understand the US's position here and we're starting to see the policy framework unfold, would you say that getting user experience right is the next iteration of adoption?
100%. And I think that user experience isn't just on the technical level. So there's things users always are going to be frustrated with. So if you go back to DeFi summer in 2021, everyone was super frustrated with Ethereum that a simple transaction cost you $100 effectively. That's never going to work. However, outside of that, once you got going to scalability, unless you hit those limits, which you will quickly at global scale, is other things that become frustrating. So in the example of needing to bridge between multiple networks, one of the reasons of Radix, we strongly believe that we'll see consolidation down to a few L1s, is that whenever you start bridging between different networks, you had delay. And ultimately, global capital markets allocate liquidity based on risk and opportunity. Anytime you have some kind of bridging delay, an arbitrage opportunity could go away or a profit opportunity could disappear. And so consolidating that on a single unified network is very much one of the reasons why the internet won over hundreds of different intranets, because you want to be able to connect with anything at any point at any moment. And so I think issuance at the moment, really we're just seeing the US stance, and also like in the UK, the Bank of England's looking at public DLTs for issuance here, of going, how do you actually sit there and go, where do I issue these stable coins? It's something people can understand. It's a dollar. They're familiar with dollars. But actually, this is just, I don't want to say a Trojan horse, but like the first thing to get people comfortable with digital assets in a more mainstream way. But it's quickly going to start opening up and being like, well, actually anything of value can be transacted on these networks. Complex financial applications can run on these networks. And suddenly that is a huge efficiency saving for TradFi organizations, institutions. It's why BlackRock and Fidelity and everyone else are talking about tokenizing all of their funds, because they streamline their operations massively and save billions of dollars a year if they could move to this. And this is just one of those steps there.
Yeah. And Erbil, to wrap up here, I want to get your thoughts on this. Relative to what Adam said, this is essentially how you're going to source liquidity at some point. So when you think about real world utility and that fundamental market shift, are we talking 3 years, 5 years? I mean, there's some patience does have to be exerted here. You can't just plug and play when there are legacy assets and education and user experience and so forth that we need to think about. What does a realistic time frame look like?
If you asked me this question last year, I would say probably 5 years or so is the time frame. But after Genius Act passed, I cannot explain in words the amount of institutions reaching out to us and trying to get the solutions in place right away, because they understand finance always works towards efficiency, and if they're late, they will be on the losing end tomorrow. So they actually are trying really hard, and these are institutions that would not move at all, even though we were nudging them for years, and now they're like moving faster than us. Like it's happening so fast that I would say it's going to happen literally in the next year or two. We're going to see at least the leading institutions changing their a set of solutions, changing the way that they work, changing the infrastructure completely just to adapt to these and not be left behind.
Yeah, well, sourcing liquidity, that's a big part of it. It is for sure, guys. Appreciate all of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.